Yeah, agree. The last till the time I want to find it, but I feel I haven't experienced.
Okay, folks, a couple of things before I start. One is a reminder that we're going to be starting on packet 1 today. So if you haven't downloaded it, it's too late to do it right now, but do it before the end of this week, because starting today, we're going to be into the packet, so the lecture note packet. Couple of loose ends on the class itself that I did not get to in the last class that I want to kind of put into the process now. I talked about the big picture of corporate finance, right? The investment principle, the financing principle, the dividend principle, and that the end game for a business is to maximize the value of the business. And I promised you that everything in this class was on that page. So I'm going to deliver on that promise. This is actually the outline for the class using the big picture to illustrate how we're going to go through the class. So for the next 3 sessions, today and next week, we're going to be talking only about the end game. What's your objective of running a business? Might sound like a waste of time for you because you want to get to the meat and potatoes of corporate finance, of discount rates and cash flows. But as I'll say today, if you don't know where you're going, it doesn't matter how you get there. We need to first establish what is it that we need to do as businesses? What's the end game? So we're going to talk about the objective. Once we get that out of the way, we're going to spend about 8 sessions talking about hurdle rates. Remember I said the hurdle rate should be higher for riskier projects and for safer projects. But we're going to talk about how to measure risk. So we're going to talk about how to measure risk, how to bring it into the hurdle rate, and how to also reflect the fact that you have 2 ways of raising capital. You can borrow money, which is debt, or your own money, which is equity. Once we've got the hurdle rate nailed down, we're going to talk about measuring returns. And again, I gave you the principles, driven by cash flows. But what does that mean, cash flows? Cash in, cash out, how do we measure that? I said it has to reflect when you get the cash flows. You'd rather get them earlier rather than later. It's a fancy way of talking about discounting. We'll talk about how discounting plays into the investment return. And I also said you can't have garnishing, right? Synergy, strategic. I'm going to at least start in the process of, if there is garnishing, how do you bring it into the cash flows? How do you hold people accountable for using what are effectively buzzwords? By session 15, we'll have the investment principle done. That's actually well through halfway through the class. Okay? After we get to that midpoint, we're going to turn to the financing principle. We're going to spend about 4 sessions talking about how do you come up with the right mix of debt and equity for your business. Is it 80% debt, equity, 100% equity, 60%? So we'll look through different approaches you can use. and follow up by spending a session on matching debt up to the assets. We've laid out the sub-principle there. Match the debt up to the assets. You have long-term assets, long-term debt, euro assets, euro debt. Talk about finessing that principle. How do you put it into practice? Then in sessions 21, we're going to start on returning cash. The traditional way of dividends, the newer way of buybacks. How much cash should you return and in what form? In sessions 22 and 23. You're saying there's 26 sessions. What are we going to do after session 23? I'm going to circle back to the objective. I said the objective of a business is to maximize value. And to do that, we actually have to measure value. And we won't have the tools to do it in session 4, but by session 24, we'll be able to come back and say, this is how everything you do in business plays out in value. Making good investments, choosing the right mix. So sessions 24 and 25.
Can you hear it?
Before you
If you're on Zoom, please mute yourself. Okay. So in sessions 24 and 25, we're going to bring it all back together. In session 26 is going to be a grand finale. Everything's going to, my objective is to bring it all together so you can see how the pieces play out. So whenever you feel uncertain in this class about an element, maybe when we talk about risk, you don't quite get it. Don't give up. Back up and say, this is a small piece of a much bigger puzzle. Hang in there to get the big picture. Now, I call this class an applied corporate finance class. And the reason I call it applied is when I was taught corporate finance, the professor kept talking about XYZ widget company in some case in 20 years ago. And to me, that did not make sense because I wanted to talk about real companies in real time. So this class is actually constructed around 6 lab experiments that will run all through the semester. What I mean by that is everything we do in this class, I'm going to apply on these companies. So let me go through the list of the 6 companies you're going to see repeatedly through the class. The first company I picked as my lab experiment, and it's a company that you're going to see most often through the class, is Disney. You know why I picked Disney? Because everybody kind of knows what Disney does, right? If I picked Alcoa, you'd be struggling for half the time. What exactly does Alcoa do? No? Or what exactly does Salesforce do? Disney, everybody kind of gets it, but you're going to see that your perception of Disney might be framed by the things you observe at Disney. Disney is a much messier, more complex company now than it used to be 50 years ago. Everything we do in this class, I'm going to apply on Disney. So when we talk about hurdle rates, I'm going to estimate Disney's hurdle rate. We talk about investment analysis, we're going to talk about how you'd look at a Disney theme park or a Disney movie as an investment. When we talk about financing mix, I'm going to talk about the right financing mix for Disney. We talk about the right kind of debt. We're going to talk about what kind of debt should Disney take to fund a theme park, a new Avengers movie. And the answers might be different depending on the project you're looking at. And finally, when we get to the dividend section, we're going to talk about how much cash has Disney actually returned, how much should it have returned? How much in dividends, how much in buybacks? Does that make sense? At each stage, we're not going to take what Disney takes as the right, does as the right thing. We're going to question, is that the right thing? And there will be times I said, that doesn't make sense to me. And at the end of the class, when we talk about value, I'm going to tie all of these back to valuing Disney as a company. So you're going to see Disney play out all through the 26 sessions. The second company I'm going to use is a company called Vale. You know what Vale does? Anybody? It's an iron ore mining company. It is the largest iron ore mining company in the world. I'm surprised you didn't say a Brazilian mining company because that's the next thing you think about. It's really not a Brazilian company. This is something we're going to come back to over and over again. We live in a world of global companies that through the accident of history happen to be incorporated in the US, in Brazil, in China, in India. It's a global iron ore mining company that's incorporated in Brazil. Now you might wonder, why do you pick Vale? To get as different from Disney as I could. I mean, think about two companies that are polar opposites, right? Disney is a service/technology entertainment company. Vale is an old-time natural resource company, a mining company, set in an emerging market. Everything we do in this class, I'm going to apply in Vale, and you're going to see the differences then in how you estimate hurdle rates for a developed market company versus an emerging market company, an entertainment company versus a mining company. So everything we're going to do in the class, we're going to apply in Vale. The third company we're going to use is a company called Tata Motors. You know why I picked Tata Motors? Because it's part of a family group. This is actually more the rule than the exception in parts of the world, Latin America and Asia. Often when you see a company, it's not a standalone company, it's part of a family group. You're saying, why does that matter? When you buy shares in Tata Motors, you've got to be aware of the fact that the decisions made at Tata Motors might not be in the best interest of the company. They might be the best interest of the group. And that shouldn't surprise you. It doesn't make it illegal. It's part of the process. So everything we do in this class, we're going to talk about how being part of a bigger group can affect your investment decision, your financing decision, and your dividend decision. The fourth company I'm going to use is a company called Baidu. How many of you have never heard of Baidu? Okay. I didn't either. You know, when I first heard of Baidu is a few years ago, I had to go to Shanghai to do a presentation. It's a long flight. I was working on a blog post that I wanted to put right at when I landed in Shanghai. So we land, I go to Google, my blog, which is a Google blog. I look for it, it's disappeared completely. So what the heck happened here? So I said, I should be able to find it with Google search. I type in google.com, site not found. $1 trillion company disappeared while I was in the air. You know why, right? Once you land in China, you can't directly click into any Google site. You can use a VPN to get there. Cutting a long story short, Baidu is a search engine that was developed for China because you have basically a gap here, right? If you're not allowed to use Google, how do you get on? So Baidu is a search engine. Think of it as the Chinese version of Google. And the reason I picked it is you've got to get a Chinese company in the mix, right? Second largest economy, both second largest financial market. I wanted to get a tech company. So it's two birds with one stone. Get a tech company in there, Chinese company. Let's see how tech companies make investment decisions, financing decisions, and dividend decisions differently than manufacturing companies or service companies. The fifth company I'm going to use, I will use through is Deutsche Bank. Why? Because you got to get at least one disaster movie into the script, right? Well, let's start with the first reason I use Deutsche. I wanted to bring in a bank into the process and ask the question, how, when you're a regulated entity like a bank, are investment decisions fine? Because a bank can't make financing decisions free form, right? It's got regulatory capital requirements, people looking over its shoulder. So my initial reason for picking Deutsche was I wanted to get a bank into the mix. Very different creature than every other company you see out there. But along the way, Deutsche has found new ways to create catastrophes for itself. Every year since 2008, Deutsche has had one disaster after another. So I wanted to see, how do you make decisions when the end of the world is constantly around the corner? And perhaps along the way, maybe we'll see some clues as to why Deutsche keeps discovering new catastrophes. And the final company I'm going to use is a company called Bookscape. It's really not a company. It's a privately owned bookstore in New York City. I've changed the name. But I wanted to see how the owner of a bookstore in New York City, I mean, remember, the business is getting disrupted by Amazon. You're a small, privately owned business. How do you make investment decisions and financing decisions and dividend decisions? Because as I said, corporate finance affects everybody. Now, as I do this, you might be just tempted to sit there and watch me go through these companies. But I'm not going to let you, because here's what you're going to do in parallel. And this is your project. You're actually going to, and I'll come back and show the grade distribution in case you're interested. This is your project. You have to first form a group. Why? Partly because of logistics. I can't handle 225 different reports coming at me, so this consolidates, it makes it 40 or 45. Second, I thought business school was about learning to work in groups and handle bad characters along the way. So, and the third is, there is a value here in working as a group. So let's suppose you create a group, there's no let's suppose, you have to create a group. Okay? The group can range anywhere from 4 to 8 people. Once you've created the group, each of you is going to pick a company. I would like the companies in the group to share a common theme. I'll give you a very direct measure of, very simple measure of a theme, and then I'll give you perhaps more complicated measures. Simple measure might be, you're going to pick companies in the travel business. So here's what you might pick. You might pick Booking.com, classic, makes money as an intermediary. Airbnb, a younger, more high growth version. You might pick Marriott, just an old time hotel company. You might throw in an airline in there, why not? And if you can find that airline, let's say is a Singapore Airlines, you can bring in a non-US company in the mix. Here's my advice to you. Try not to pick 5 companies that are roughly the same size, do the same thing, are in the same market. Try to get some diversity across your group. You know why? Because one of the things I'm going to look for is how you talk about differences across your 5 companies. Why does Airbnb have a lot less debt than Marriott? I'd like you to think about what is it about these companies that leads them to different decisions. That's a simple example of a group. Here's a more complicated one in case you want to get creative. Every year that I teach this class, at least one group is formed around something like vice. What does that mean? You pick a gambling company, you pick a tobacco company, you essentially take ESG and turn it on its head, right? So get creative in this. I'm not looking for 5 companies that look the same. I'm looking for 5 companies that are different, but within the same business broadly, because it'll save you some time in terms of doing the macro background, right? If you're doing travel, you can look at travel collectively as a group, and then each of you can focus on your companies. Every week, this is what I will nag you about, because this is an ongoing project. It's started as of right now. So start thinking about companies, start thinking about groups, because you want to get that picked as soon as you can. So as we go through the class, you can apply whatever I do in class with my companies to your company. That would be in a perfect world. We don't live in that perfect world. Here's what's going to happen. You're going to fall behind. I'm going to be about 4 weeks ahead of you. That's in the good scenario. 13 weeks ahead of you in the bad scenario. But if you can keep up, it will make your life a lot simpler. So that's part of what you get every Thursday, starting tomorrow, on here's where you should be in the group. I'm partly trying to nag you and partly trying to keep you on track on this project, because this is where you will learn the bulk of your corporate finance, not in the quizzes, not in the exams, but actually applying what you learn to real companies. But I will put some constraints for your own protection. Please listen, because every year, few will ignore these constraints, and then the 9th week, you'll come to me and say, it's not working for me. So here's what I want you to avoid. I want you to avoid money-losing companies which are young. I'll tell you why. Corporate finance becomes very simple. If you're a young money-losing company, how much money should you borrow? Don't think too long. If you're already young and money-losing, you shouldn't be borrowing money. If you're borrowing money, it's because you're desperate. How much should you pay in dividends if you're a young money-losing company? Nothing. So a corporate finance project boils down to, if you take the right projects, everything else goes away. So part of the reason I want you to avoid young money-losing companies is for that reason. You probably also want to avoid old companies that always seem to lose money, which pretty much takes 80% of the airlines out of the mix, but that's good, take them out. So avoid money-losing companies, especially if they have a long history of losing money or never made money. Second, avoid banks. I'm probably repeating myself, but avoid banks because they're regulated. You won't get too much. Again, it's not that they're difficult to analyze, it's just that you don't have too much discretion. You can't pick a different debt ratio. So avoid money-losing companies, avoid banks, and that's pretty much it. You can do any other company you want. You're saying, but that takes a lot of, there are 45,000 publicly traded companies on the face of the earth. You cannot tell me you cannot find a company because I put these two constraints on you. And don't think too long. Don't ponder this choice too much. I'd rather that you pick a company in week 1 and change your mind in week 4. Because as you work each week, you can try things in your company. And if you switch a company, it becomes easy to do the work because you've already done it. So make your choices quickly so that you can get going on the project. The project will be worth 40%, but it's broken, 30%, but it's broken down into 2 parts. There's a 5% for getting me numbers, and you'll see later why I need the numbers the day before the project is due, which is the last day of class. And the remaining 25% will be for the actual project. There will be a case during the course of the semester. I haven't written it yet. Every year I try to pick something that is, last year I picked the case I wrote was called Netflix Fit. Basically, I was looking at how much Peloton was soaring, and I'm saying, hey, if you're Netflix, why couldn't you introduce something very much like a Peloton app? You spend, what, $18 billion on content. This is going to be like a drop in the bucket. Charge your Netflix subscribers an extra $5 for Netflix Fit. So I wrote a case around this, it's a concocted case, but it's essentially to get you to try, especially the investment analysis part. We have to estimate cash flows. So I haven't written the case yet. I'm trying to think of something that'll be interesting, but there are lots of things going on out there that I can build on. But that case will come to you somewhere around the 3rd or the 4th week. It'll be due within 2 weeks. I'd prefer you keep the same group structure that you have for the project for the case as well, okay? Because that makes the logistics easier. But that case will be worth 10%. In terms of quizzes and exams, there are 3 quizzes for the class, and the session dates are specified there. I know that you might have to miss a quiz, and if you do, it's not the end of the world. As I said last session, I'll move the 10% to the remaining quiz and the final exam. So you don't lose the 10%, it'll just go to the remaining quizzes. So if you miss the first quiz, the second quiz will be worth 12.5%, the third quiz will be worth 12.5%, the final will be worth 35%. If you miss the second quiz, it'll go to the third and the final. So basically, it'll always move to what's left in the class. I have a page of quiz rules so you can read them and you get a chance. It's open book, open notes. For the moment, an open iPad if you have your notes in digital form. For the moment, I'd prefer that people don't open their laptops. It's kind of a fiasco when they do. So for the moment, I'm going to say no open laptops unless your digital copies are on your laptop, in which case you might have to open your laptop. Yeah. But you can't use Excel. You can't do the tools that are out there because, and it's going to be pretty much an honor system in that sense because you open your iPad. I have an iPad Pro. I have Microsoft Excel on there. I'm not going to go around looking over your shoulder, seeing if you're using Excel. But so my requirement is you can use your laptops, but you cannot open Excel and you cannot use spreadsheets. It actually is to help you because I've discovered that when people open spreadsheets, it actually takes them more time to work through to the answer because these problems are not meant for spreadsheets. They're meant for thinking through the process. So the 3 quizzes and the final exam date is not specified. And the rules are basically there. So rules of group work is you monitor your group. You find ways to keep group members going. Please don't bring me into your group dynamics unless you absolutely have to. because logistically it just can't be done. So figure out ways. If you have a group member who's not pulling his or her weight, what's the Godfather? Especially what's the part of the horse's head on the pillow? Okay. There are ways in which you can bring people into line, and I will let you figure out what they are. Okay? And as for the class itself, the only rule is be civil, let people ask questions, don't jump down their throats. Let me handle making sure we get through the material. Don't get pissed off because somebody keeps asking questions. That's completely okay. I will make sure that I don't go off on tangents. Okay? So let me handle the management of the class. And as I said, the acoustics of this room sometimes require that I take a question you ask me to repeat it back, and I'll try to do that if I remember. But that's pretty much the structure of the class. If you, I won't go through the project presentation. There's a presentation you can download for the project because it just describes in detail what's involved in the project. For the moment, it's going to look like Greek to you because each section, you say, what the heck is that? It can also look a little intimidating. If you've never done corporate finance, I can't do that. Trust me, you can, and you will. And I will drag you across the finish line if that's what you need to do. But 36 years, every year people start out saying, I'm a history major. There's no way I'm going to find the optimal financing mix for a company. You will, and you can. And that's where you're going to learn corporate finance. Any questions on the logistics? So we're going to start on lecture note packet 1. Okay. So as I said, the next 3 sessions are going to be all about setting the end game for a business. What's the objective? You start a business, and I'm not just talking about publicly traded companies. You're a private business. When you start the business, what is your end game as a business? So I'll give you the classic view of what drives businesses. It's best encapsulated in an article that Tom Friedman wrote for the New York Times. I'm sorry, not Tom Friedman, Milton Friedman wrote for the New York Times. Nothing that Tom Friedman writes should be read for this class. The world can get flat or flatter, who cares? But this is a Milton Friedman article from 1971. It's funny, of all the things that Milton Friedman wrote, one of the great economists of all time, Nobel Prize winner, this is one of the most widely read pieces. And he stated the classic view of business. He said the objective of business is to deliver products or services that customers need or want, and to make money off those products and services. The end game for business, he said, is to make money. It's not to serve society. It's not to provide other side benefits. The focus is on delivering value. And of course, in the last 20 years, there's been pushback. And I'm going to talk as we go along about the pushback. The first has come from the sustainability crowd. Their argument is the end game for business should be to take care of customers and employees. Implicit there is also the view that if you do that, it'll make you a more valuable company. But Milton Friedman would have agreed with that as well. If the way, excuse me, if the way you increase value is by focusing on share, there's nothing that contradicts what Milton Friedman said. So we're going to come back and talk about what it is that the sustainability argument is and what part of corporate finance they're disagreeing with. The second pushback has come from those people who say, why are we so focused on equity investors in a business, the owners of the business? Why don't we bring in the other stakeholders, employees, and I'll list out all the other stakeholders. That's the basis for stakeholder wealth maximization. We'll talk about where they come from, where they disagree with corporate finance, and how you reconcile, if you can, the difference. And the third group pushing back against traditional corporate finance, and this is more recent, the last decade, is the ESG group, where the argument is businesses have a bigger objective. It's not just to make money on products and services, it's to serve society. There are environmental goals and societal goals that you got to bring into the game. during the next 3 sessions, I want to directly confront what those 3 schools of thought are pushing for and how you reconcile that with traditional corporate finance and when you part ways. So let's start with who these stakeholders are. When people talk about stakeholders, what the heck are they talking about? So let me list out all of the potential stakeholders in a publicly traded company. It gets a little easier with a private business, but it's a publicly traded company. There are, of course, the shareholders. The shareholders are technically the owners of the business. They control the way the company is run through a board of directors. Managers are answerable to shareholders. So in the traditional world, that was your primary group, but that's your first group. But let's go through the remaining stakeholders. I said there were 2 ways a company can raise capital. It can raise capital by issuing shares, equity, or it can borrow money. Do lenders have a stake in the business? Of course they do. The way they get paid might be different. Interest payments are fixed, payments are contractual. But if you're a lender, you too are affected by how a business is run. Those are the capital providers. But let's keep going. A business is employees. Do employees care about how of course they do, right? They have to get wages from the business. They have to negotiate for the best wages. So you got employees. So now we have shareholders. We have excuse me. We have lenders. And we have employees. There are customers. If you're a customer from a business, your interactions with the business is the business provides you a product or service. You pay for that product or service. And of course, you want the best possible product or service at the lowest possible price, but you have customers. Society is kind of a side player, but it's part of the game as well, right? It shows up either in explicit ways by having a tax it collects from the company that it can use for other purposes, or regulations that restrict what a company can do. And implicitly, because companies create side costs and side benefits that cannot be traced to the firm. And finally, you have competitors. Do competitors care about what you do? Of course, they want you to do badly because they can do well then. That's the nature of the game. But in a broad sense of the word, they're also stakeholders in the game. So I want you to think about that. There are 7, 8 stakeholders in this game. And when people talk about take care of stakeholder interests, all of those players now enter the game. Now, implicit in both the sustainability and the stakeholder arguments is the presumption that if you focus on just shareholders, you're going to abandon all of the rest. So I'm going to come back and examine that question first. Are they mutually exclusive? Is taking care of shareholders somehow mean that you don't care about employees and don't care about customers? Because I think that's an extreme view. But let's first start on why corporate finance is so focused on just shareholders. You've got all these different groups. Why do we focus on shareholders, not on lenders or customers or employees or society? What is it about shareholders or the nature of the relationship with the company that makes them special? Anybody want to try? Yeah.
You can see their wealth in real time.
Well, lender can see loss of wealth in real time too if you may fail to make an interest payment. Employees see the drop in wages. Everybody can see what they get out of the firm. But if you're a lender to a firm, go ahead. So can lenders. Come on, banks can lose everything. Employees lose their pension funds and their wages. You could actually argue that employees have more to lose than shareholders do because shareholders can spread their bets across 50 companies. Sorry, go ahead. We're getting closer. So let's play a game. You're a lender. Okay? I come to borrow money from you. As you lend money to me, how do you protect your interest? What do? You first specify an interest rate, and then you specify your principal payments, and then you write all these covenants. You can't do this. So you are contractually you might not do it well, but you have a contractual relationship. You're an employee. You come to work for me. We have a wage contract. Now, we can talk about whether unions are strong or weak, or whether, but there is a contractual agreement. You're a customer. You buy products and services from the company. They don't measure up. You can return the product or service. You can complain about it, but try to get your money back. But implicitly, every time you buy a product or service, there is a contractual agreement. You're saying, what about society? Taxes are a contractual agreement, right? Now, governments might not do a good job about writing tax laws, but ultimately, when you think about taxes and regulations, they're a contractual relationship. And of course, your relationship with competitors is governed by antitrust laws and a whole degree of. The point I'm trying to make is shareholders are the only group who don't have a contractual claim on the company. So as a shareholder, what do you get? Whatever's left over. And if I don't protect you, you know what you're going to get? Nothing. The reason we focus on shareholders is not because they have special virtues. It's not because we're picking favorites. It's because they're the one group among all the stakeholders that doesn't have contractual protection. So here's what tends to happen in practice. We start with the ultimate corporate finance objective. We want to maximize the value of a business. And then we remember that as managers, because you're the ones making decisions, the group you answer to is not all of the business, but to shareholders. So you know what happens? You say, look, I need to keep shareholders happy to keep my job. So I'm going to focus on maximizing shareholder wealth rather than the total firm value. Hang in there with me because it looks like I'm playing on words. But rather than focus on maximizing the value of the business, I focus on maximizing shareholder wealth. And then I run into a little bit of a practical problem. You know what the practical problem is? How the hell am I going to measure shareholder wealth? Now, I could call in McKinsey to value the business. But the problem is, as you'll find in valuation, there are judgments you make and they're subjective and there can be disagreements. Wouldn't it be nice if there were a number out there, which even if it's wrong, is an unbiased estimate of what my shareholders are worth? I don't want to be mysterious, but if you're a publicly traded company, what does that number become?
Price per share.
The stock price. In practice, here's what tends to happen. Rather than maximizing firm value, managers focus on maximizing shareholder wealth. And because shareholder wealth is difficult to estimate, they end up maximizing stock price. Do we give up something by maximizing stock price? Absolutely. Because what are we implicitly assuming then? That markets, when they assess stock price, are good assessments of shareholder wealth. And when you maximize shareholder wealth, you're not doing it by ripping off your bondholders or the other claim holders in the firm. So I'm going to give you two extreme ways this can play out. So you're a company and you've decided for practical purposes that you want to maximize stock prices. Let's see how this plays out in practice. So basically the focus comes from maximizing stock prices. Let's talk about how this focus plays out in practice at the two extremes. Before we do that though, I want to start off by dispelling this myth at the heart of both sustainability and ESG and or even stakeholder wealth, that somehow if you maximize shareholder wealth, it has to be at the expense of employees and customers and society. So let's start with why, when you think about objectives, why you end up picking shareholders is because you can't constrain yourself. But the reason you pick share prices also is they're observable. You don't have to have McKinsey come in and estimate it. And they give you instantaneous feedback on every decision you make. Remember 2 weeks ago when Microsoft bought Activision? If you're a Microsoft manager and you ask the question, what does the market think about this acquisition? It's a very simple metric you could use. You announce the acquisition. The moment after the acquisition, what happened to Activision stock price? It shot up. But the moment after the acquisition, there was also an effect on Microsoft's stock price. And that assessment tells you what markets think, at least at that moment, about the acquisition. We're going to come back and talk about, was that a good assessment? Maybe markets don't know enough, but you get instantaneous feedback on something that you can observe. So we can see why people focus on stock prices, but it does come at a cost. And here's the most extreme one. And this is actually the vision that a lot of people bring to corporate finance. It's the Barbarian Vision. I don't know whether you're familiar with the robber barons, but the late 1800s and the early part of the last century, US companies were run by very wealthy men, for the almost every single one of them, who were ruthless, right? Andrew Carnegie and Rockefeller left no enemies alive on the battlefield. They essentially said, our focus is not even maximizing stock price, it's to maximize our wealth. So in the robber baron vision of the word, everybody else gets screwed. Because if you're a robber baron, here's what you do. You take advantage of whatever loopholes banks give you to steal from them. If you're a robber baron and you have employees and they're not protected, you find a way to make them work for slave wages. If you're a robber baron and you're looking at customers, you say, let me charge the highest prices I can. Remember, both US Steel and US Oil, Standard Oil, were monopolies. And they charged higher prices because they could. And robber baron relationships with governments are kind of mixed, right? Because often they're wealthy enough that they can control the levers of government. Remember, JP Morgan in 1912 stopped a run on the market by gathering together 5 people. It wasn't the government that did it. And what do robber barons do to competitors? They stomp them out. In the robber baron world, letting companies maximize stock prices will mean every other stakeholder gets devastated. Now, if you believe we live in a robber baron world, of course you should have issues with corporate finance. That's an empirical question. We'll come back and look, is that the world we live in? But think of that as one extreme. But in that extreme, here's what we're missing.
Professor?
For the most part, a company cannot go out and maximize stock prices if it doesn't take care of the other stakeholder groups, at least to some extent. Here's
Hi,
a very
Professor.
simple, sorry.
Sorry, the slides you are sharing on the Zoom is not the same with the one you share in the screen.
Let me restart the sharing center. So let's start with the employee versus shareholder debate. Let me ask you a question. Would you rather right now, be working at Amazon or Walmart? Think about it. I don't want to know the answer. Think about it. Would you rather be working at Tesla or GM? The reality is, if you look at the companies where employees are most satisfied, you can go on Glassdoor, for instance, and check this out. This might be pure coincidence, but the companies where employees are most satisfied are companies that are doing well in terms of market price, partly because employees get compensated with some degree of equity, but partly also it's really depressing to work at a company which is on the verge of going under, right? You have no freedom, no flexibility, no degrees of choice. So this notion that if you maximize shareholder wealth, it must be from exploiting employees strikes me as an extreme one, because the reason I think Amazon's minimum pay now is $15 an hour. And I think they also offer college education for free to people who work in their warehouses. Do you think Walmart can afford to do that? Best Buy definitely cannot. And Bed Bath & Beyond, there's not even a dream of doing it. So let's start by accepting the proposition that in most companies, taking care of employees and doing well are not mutually exclusive. They often go together. You're saying, what about customers? Why has Amazon succeeded? Because they deliver on the, I mean, there's a reason you use Amazon Prime if you want something delivered in the next 2 days. Because It gets delivered and you don't like it. I live in San Diego. I can go there's drop boxes all over the city. I don't even have to, go out and get a refund and send them thing. I just go drop it in the bag, scan, I get the instantaneous credit. When you look at companies that become successful in terms of market price, it's usually because their customers like what they're doing. I mean, if you ever talk to somebody you take somebody who owns a Tesla to dinner, my suggestion is please don't do that in the first place, because if you do, here's all you will be talking about. The guy will talk about his Tesla all dinner long, how he loves his Tesla, how it does this. Come on, you've got a family, you've got kids, can we talk about them? No, let me talk about my Tesla. Have you ever gone to dinner with somebody with a GM car? Says, let me tell you about my Buick. It's really a good car. There's a reason companies get successful, and it's not by exploiting and ruining their customers. It's by delivering a product or service that those customers want. Again, we can talk about exceptional cases. There are clearly cases where companies take advantage of their customers to increase shareholder wealth, but for the most part, taking care of your customers is partly what makes you successful. You say, what about society? Companies that are successful must be exploiting society. I really don't understand this argument. How many jobs has Amazon created over the last 15 years? It's been the biggest job creator in the US, more than 1 million jobs. When you think about companies doing well and being able to do things for society, companies that are doing well are more capable of doing good for society than companies doing badly. There's a lot of stereotyping in this argument, right? And Hollywood plays a role in the stereotyping, because you watch movies about companies, they're always run by robber barons. Have you noticed this? And the people challenging the company are almost saintly. I'll give you an example. One of my favorite movies is a movie called Other People's Money, because it actually adds some nuance to this debate. How many of you watched this movie? It's an old movie. Danny DeVito is in it. It's a movie, actually, as I describe the plot, you're going to say, who'd go see this movie? It's actually a fun movie to watch. It's about a New England-based company that makes phone cables. The old days, you had to make these physical cables that ran under the ocean. It's a company that makes phone cables. And in this movie, an activist investor, I told you it's not going to sound like a fun plot, decides to target the movie for a hostile takeover. So you know who plays the role of the activist investor? It's Danny DeVito. So visualize Danny DeVito. If you've never seen a movie, go take a look at him. Because I'm now going to give you the counterpoint. This New England-based company is run by this visionary CEO who cares about his employees, society. And that CEO is played by Gregory Peck. Already you can see how the stereotype is. There's corporate finance, Danny DeVito. There's the anti-corporate finance, Gregory Peck. But what makes this movie interesting is it doesn't play to type. In fact, the climax of the movie, the last 10, 15 minutes, are an annual meeting. I don't write the script. This was actually the movie. And at the annual meeting, Gregory Peck gets up and he says, this guy will ruin the company. He plans to shut the company down and sell it for parts. And you will all lose your jobs. And employees and shareholders all get up and applaud. Oh, what an amazing man. And then Danny DeVito gets up and he says, look, I am going to take over your company. I am going to shut it down. I'm going to sell its parts. But you can blame me, but you should really be blaming fiber optics, because you're producing cable that nobody's buying. And you can either bleed to death gradually over the next 5 years and keep losing jobs, or I can put you to death right now. He didn't use those words, but essentially cut it off right now. And often we target activist investors, not that they don't do things which are at the margins, for doing things that are the consequences of some macro factor that's going to play out anyway. So I'm going to send you the link to the movie. If you can watch it, because I think it shows you where the preconceptions we bring come in. Because when you watch that, you're saying, no, I'm going to pull for the CEO. He's trying to protect the company. He's trying to save the jobs. Again, but for the most part, if you think about being able to help society, do things for society, the companies that can do it the best are the companies that are also doing well in financial markets, making money, because then you have the excess resources to be able to do it. So I'm not establishing a case here. I'm just saying start questioning. When people say, if you maximize shareholder wealth, it must mean that you're not taking care of customers. It must mean you're not taking care of employees. Take the 20 companies that have gone up the most in value in the last decade and ask yourself, did those companies get there because they have unhappy employees and customers who don't like their products, or did they get there because they took care of these stakeholder groups? Any questions before? So I'm going to give you the other extreme. So one extreme of how you think about corporations is the robber baron world. Let me give you the other extreme, because I think it kind of illustrates where corporate finance, I call this a utopian world from which traditional corporate finance is born. And I've already kind of given away what I think about the assumptions that are made in this world, right? When did utopia exist? It didn't. It's just a made up world where everything works the way it's supposed to. So I'm already admitting up front that the assumptions I will need in this world are not realistic. In fact, I'm going to come back and shred them. But think of this as the traditional world of corporate finance. In this world, companies can focus on maximizing stock prices, and all the other stakeholder groups are going to be fully protected. So how the heck does that happen? We'll take you through the game. In this world, shareholders have complete power over managers. How do they get that power? They vote at the annual meetings, they have boards of directors that protect their interests. They keep managers in line. So when managers make decisions, guess what they do? They focus on what's good for shareholders and they do the right thing. Utopian worlds are hang in there. So shareholders have complete power over managers. Managers do what's in their interest. In this world, if you're a lender, you fully protect yourself when you lend money to me. Every loophole is cut off. So I make sure that I follow the contractual agreements. So the covenants, I follow the covenant. And I do it for two reasons. One is because there's a contractual agreement. The second is I worry about a reputation effect. You know what I mean by reputation effect? I'm not done borrowing. I might have to borrow 5 years from now, 10 years from now. And if I exploit lenders now, they might not lend to me. So in this world, lenders lend money to the company and the company doesn't rip them off. In this world, financial markets become really important because you're focusing on maximizing stock prices, right? So for stock prices to reflect value, first, investors should be getting information about the company that's accurate and on time. So in this world, managers reveal information to companies honestly and on time. You're saying, that doesn't happen. I told you it was a utopian world. I'm not saying this is the way the world is. This is the way corporate finance assumes the world is to get to its starting point of it's okay to maximize stock prices. So what would this world look like? I've been an Apple user since 1981. And for the longest time, Apple did not have a laptop. I think it was in 1989 or 1990 that they introduced the first laptop. It was only very loosely speaking a laptop. It weighed like 20 pounds and got really hot, you know, but you could keep it on your lap, get burnt and go into the hospital. But we were happy. Finally, we had our own laptops as Apple users. It had one tiny problem. It sometimes caught fire. Now, spontaneous combustion is not a feature you usually go looking for in a laptop, right? You don't go to Best Buy and say, that doesn't have. It'll make your next presentation incredibly memorable, but your next plane trip could be a disaster. What was happening is the batteries in the laptop were heating up and combusting. So in the world that I described, what did Apple do? They'd run out to financial markets and say, hey guys, our laptops are hot. and then leave. This tells you a little bit about how companies actually lie or hold back the truth, right? It's not technically Apple's telling you the truth, right? That laptops are hot. But when you hear the word, you think they're selling a lot. You don't think of going up in flames. So let me take that back. In the world that I described in, Apple would go out and say, our laptops are catching fire. We wanted to let you know right away so that you stop buying our laptops. And in return, markets in this utopian world are filled with intellectual, deep thinking traders. Do you know what a trading room would look like in this world? It'd be full of deep thinkers. So when a new story comes out, says, let's talk about the effect on long-term value before we react. If any of you have been in a trading room, this is not exactly the way trading rooms work, but in this world, markets are cool and rational about the way they assess information. You know why we need that, right? Because we need the market price to reflect value. So we need information to go to markets in a way that reflects what you know, and markets react appropriately. And finally, in this world, there are no social costs or social benefits. Why? We took the classic economist approach to dealing with problems. Let's just assume them away. We said there are no social costs and social benefits because everything can be traced and charged to the company. So if you create an environmental cost, we just charge you the expense. You put it as an expense. It stops being. If you create a social benefit, we'll give you the cash flow benefit. In this world, you've essentially made it safe for companies to focus on maximizing stock prices because you can't do it in the bad ways, right? You can't do it by ripping off lenders. You can't do it by lying to financial markets. You cannot do it by creating huge costs for society because I've essentially assumed those problems away. So what's the only way to increase stock prices in this utopian world? You got to go out and run your business better, produce better products and services, take better projects. This is a world that's safe for stock price maximization. But it's a utopian world. Every single assumption I listed is an assumption that you can argue against, right? You can argue that shareholders have little power over managers. You can argue that lenders are not fully protected. You can argue that markets are not fully efficient, either because managers lie to markets or because markets are not cool and rational. And you can argue there are lots of social costs and benefits. But in the utopian world, you can see why maximizing stock price is safe because every side cost has potentially been dealt with or assumed away. So what I'm going to do next is going to sound strange, but I want to take this utopian world, which is after all at the core of corporate finance, and rip it apart, take every single assumption I listed and talk about why it'll break down. And by the time I'm done, you're going to say, this is crazy. Why are we even maximizing stock prices in the world we live in? But I'm going to rip it apart and then say, now that we've ripped it apart, what do we replace it with? So let's start with each of the linkages and think about what can go wrong. Do you think shareholders at Tata Motors have complete and total power over its managers? How about Baidu? Or even Disney? You could argue that shareholders' power over managers is either non-existent in some companies because of the way corporate governance is structured, or very weak in others. So I'm going to start by arguing that in many companies, shareholders have little or no control over managers. So guess what managers do? Whatever's in their best interests. In many companies, lenders lend money to the company, but if they don't protect themselves, it's not a question of whether they will get ripped off, it's when. And I'm going to give you examples of even big name companies. They said they won't do that. Do managers reveal information to markets honestly or on time? Are you kidding me? For the last 20 years, we've seen companies often hold back on information or sometimes even be deceptive about the information. So information doesn't come to markets honestly and on time. And markets are often not cool and rational. I mean, take a look at GameStop a year ago, right? Cool and rational would not be the first two words that come to mind on what's happening to stock prices. And finally, it is a reality that what companies do create costs for society. Take the social media companies. For the last decade, that's what we've been arguing, right? What are the costs that are created by Facebook and Twitter for the rest of society? So arguing that they don't exist is being in denial. So I'll start with the first of these linkages. In the first of these linkages, we assume that stockholders have complete power over managers. And I gave you two mechanisms they can use. The first is the annual meeting where they get to vote on who sits on the board and perhaps even give direction to the company. And the second is through the board of directors, which in theory is there to protect the interests of shareholders. In fact, Delaware courts have argued that that is their primary responsibility. Make sure that you take care of the shareholders. But in practice, neither mechanism works that well. Let's see why. Let's take the annual meeting. First, how many of you are shareholders in publicly traded companies? Okay, quite a few hands. By the time you're done with the 2 years of the MBA, you'll have no wealth left, so that's all going to go away. But for the moment, you're starting off as shareholders. Good. Let me ask you a follow-up question. How many of you have been to an annual meeting for a company? Good, we have one, maybe two. So let me ask you a third question. Given that you're shareholders in a company, why did you choose not to go to the annual meeting? I'll make this personal. I'm a shareholder in 53 companies. I've never been to an annual meeting. I'm a shareholder in Coca-Cola. You know what going to an annual meeting would require me to do? Make a reservation on United to fly from New York to Atlanta, and they rip you off on that flight all the time, like $300 each way. So it costs you $600 round trip. You end up staying in the Peachtree district or whatever that is in downtown Atlanta, which seems abandoned most of the time when the businesses stop. That'll cost you another $500 in a hotel room with Uber and other stuff added in. By the time you're done, it's $1,500 that you've spent to go to an annual meeting. That'll wipe out my profits for the year. For most of us, it doesn't make sense to go to annual meetings because we don't have enough money at play. We'll talk about what about institutional investors, but for most investors, going to annual meetings does not make economic sense. But companies do offer us an alternative, right? Even if you cannot go to a meeting, in theory, how can you be there virtually? What is it that they allow you to do? For as long, even before you had online, you had a proxy vote. In the old days before online, you know what the proxy vote looked like? You'd get this fat envelope in the mail about 6 weeks before the meeting, and then it'll give you a chance to vote on all of those things coming up at the meeting. I don't know about you, but whenever I used to get those fat envelopes, my only decision was, if I was feeling socially conscious, should I put it in recycling or should I put it in trash? I'm not opening and reading 15 pages of proposals that I have no interest in and voting for people. After all, they picked the people already. I haven't heard of any of them. So you know what happens, right, to most proxies? They never get returned. So let's ask the question, what happens to all those proxies that don't get returned? So I'm a company, I mail out 10 million proxies, 5.5 million don't get returned. What happens to the votes? Because I have 1,000 shares in Coca-Cola. When I throw that into the recycling or trash, that's 1,000 votes, right? What happens to those 1,000 votes at most companies? They're viewed as votes in favor of incumbent management. I'll give you the analogy. It's like having an election where the incumbent gets the votes of anybody who doesn't show up to vote. No US incumbent would ever get defeated, right? Because you start out with a 49% turnout, you already won the election. You might as well announce I won the election right after they say 49% turnout. It's a system tilted in favor of incumbents. And you know how this shows up? Often you'll see the Wall Street Journal report the results of a vote at an annual meeting. I'll give you an example. About a decade ago, Jamie Dimon was being challenged on a practice that's very common at many US companies, where he was both CEO and chairman of the board at JP Morgan. And we'll talk about, what's wrong with that. But shareholders did not like it. They got a vote on the floor of the annual meeting where they decided to vote on whether Jamie Dimon should continue to be chair of the board. The Wall Street Journal reported the next day that Jamie Dimon won the vote 66%, 34%. What's your first reaction? Most people want him to stay on as chair of the board. What I read was, this must mean about 2/3 of the people who actually voted against him being chair, but because so many people didn't show up, you end up winning the vote. It is very difficult, not impossible. We'll talk about what activist investors do that tilt the odds. It's very difficult to win a vote against incumbent management at an annual meeting. The process is skewed towards incumbency. You're saying, what about the big institutional investors? They must be able to go to these meetings. They must care more. I wish they did. You know what the track record of institutional investors include mutual funds, include pension funds, include index funds, which are a particularly special case now because they account for a big chunk. You know what most institutional investors do? They rubber stamp incumbent management. This chart shows you the percentage of the time that mutual funds vote with incumbent managers. So when you put your money in Fidelity or State Street or T. Rowe Price, they create a mutual fund and they own 30% of a company. You think they're voting the best interest of shareholders, but what they're often voting is, what does the incumbent management want? Let's vote with them. Why? Because it's too much work to challenge incumbent managers. That's the first problem. They don't have the resources, because if you're Fidelity and you own stock in 150 companies, the last thing you want to do is fight 150 fights. The second is there might be some potential conflicts of interest, which is that company might have Fidelity funds as one of the offerings in their pension fund. You want to piss off incumbent management too much. But the bottom line is, traditionally, institutional investors, when they don't like the way a company's run, you know what they do? They sell and move on. They vote with their feet. Don't expect institutional investors to fight your battles for you as a small investor, because they don't have the stomach for it. And here it's worth asking, what has the influx of index funds done to this game? If you're an index fund, let's say you take the largest index fund in the world, the Vanguard 500 index fund. There's no way you're going to be, because it's not even consistent with your mission, right? Your mission is not changing the way companies run, it's just reflecting what the market does. So one of the side debates that has come about as more and more money pours into index funds and ETFs is, what is this going to do to potential corporate governance, challenging managers? I would be more pessimistic if institutional investors had been more activists in the first place. If you saw on that previous graph that mutual funds were voting only 50% of the time with governments, I'd feel more sympathy for mutual funds arguing, this is terrible, you shouldn't go into index funds. But you were rubber stamps to begin with. What difference does it make that an index fund rubber stamps management rather than institutional investors? Long story short, annual meetings don't work very well at keeping management in line. We'll talk about something that could alter the dynamic, but for the most part, in 95% of companies, annual meetings are not the mechanism you can use to tell managers you're not doing the right thing. And if it's bad in the US, it gets even worse outside. In Japan, for a long time at annual meetings, you know what used to happen? First, nobody would challenge a Japanese manager because it's not done culturally. They're older, they're better educated, they're, basically you. But once in a while, you'd get an activist investor. This guy called Asher Edelman decided to buy a stake in a Japanese company because he wanted to challenge management. So he actually flew out to the meeting in Tokyo. He got up to speak, and this whole crowd of people in the back get up at the same time and start yelling at the top of their voices. Every time he got up, he got shouted down. You know what the company had done? They'd hired Yakuzas, which is kind of a criminal enterprise, to come in and make sure that they weren't challenged. You say, that's not right. Lots of things in the world are not right. This happens to be one of them. And in Europe, for the longest time, annual meetings were incredibly polite affairs. People would sip wine. Those barbarians in the UK and US get up and challenge, man. We don't do that in Europe. I still remember when the CEO of a French company was challenged at an annual meeting, and she said she felt bad for the person challenging her because they'd be impolite enough to ask. I mean, the stockholder got up and said, well, you seem to have a castle that you own as a company. Why would a consumer product company need a castle? It turns out that she was living in the castle and the company was paying for it. But she felt that this was an affront, that you'd be asked this question. Annual meetings don't work. So let's turn to the board of directors. What about the board of directors? Do they operate as a check on management? The answer is not really. For a few reasons. One, if you look at who sits on the board of most companies, it used to be that CEOs picked the people who sat on their boards. So let's play a little game. You become the CEO of a company. You're trying to put together a board of 15 people. And you have two choices. You can pick the 15 most intelligent, well-informed people you can find who will challenge you and keep you on your toes. That's option one. File that away. Here's the second option. You walk into the bar area of your country club and you look for the 15 most slosh people you can find. Which is going to make your job easier? When John Mack became CEO of Morgan Stanley, the first 3 people he put on the board happened to be members of his country club. I'm sure they were very intelligent, curious people, or maybe there were 3 very drunk people. But my point is, if you look at who CEOs pick, it's not human nature to pick people who will challenge you. You will pick people who will go along. Now, it's true that in many companies, getting the names of who sits on the board has been turned over to a nomination committee. But if you think that nomination committee is coming up with names that they haven't checked with the CEO, you're being delusional. So the composition of the board often is a reflection of people who will tend to agree with the CEO. Second, in many of these companies, directors get equity stakes, but they're tiny. Often they're actually given shares in the company to give them an equity stake. But you look at how much money they make as directors and how much money they make as shareholders. Guess what you're going to find? They make more money from their director pay and pensions than they do as shareholders. And it's human nature then to say, I'm going to put my interests first, and I think like a director, and I'm dependent on this paycheck. I don't care about the shareholders. And in some companies, in fact, many companies, I'm amazed at how many CEOs of other companies sit on the boards. And these are active CEOs. How the heck do you have the time to be both the CEO of a company and a director of another company? And there, I think, is the answer, because if you look at why boards of directors have been so ineffective for so long. The first, I think, is anytime you have a meeting and it's a formal meeting, somebody pulls out, used to be a book, Robert's Rules of Order. It's deadly, because once it gets pulled out, nothing will happen at the meeting, because it has to go through the script before it passes through. Boards of director meetings, you guess who sets the agenda? The CEO sets the agenda, and it's very difficult to deviate from the agenda. You set the agenda, you control the debate. Harold Janine, who used to be CEO of ITT, he died a few years ago, but he invented the conglomerate. Now, said in his memoir that in his years as CEO of ITT, there wasn't a single decision that the board made that wasn't unanimous. Think about it. If every decision the board makes is unanimous, you're either doing everything right, which nobody does, or you got a perfect rubber stamp board. Second, the last 20 years, people have tried to make boards more independent. Right? It used to be that boards were composed of your cousin. There's still companies. Now, Tesla is a classic example, but there's still companies that do it. But for the most part, this is Sarbanes-Oxley, you try to remove the obvious insiders. So that should have made boards better, right? But unfortunately, it doesn't seem to have any effect on board effectiveness. And I think the reason is psychological. Let's assume that, let's pick a company, Salesforce. You get an invitation to become a board member. So you walk into your first board meeting. And Mark Benefort walks in, he's the CEO of Salesforce, he founded the company. And he starts describing what the company does. You start with an easy question. Does Mark know a lot more about Salesforce than you do? Obviously. And psychologically, it turns out that when you have an authority figure, somebody you think knows more than you do, you start kowtowing to that person's view because that person knows more. It's very difficult to challenge. Imagine getting up and challenging, I forgot about challenging Elon Musk at a Tesla meeting. You might not make it through the meeting. But a company where the founder CEO is talking about the company, and you think there's something off, but that person knows a lot more. It's very difficult to challenge, which means that you can't just fix this. It's not a checkbox fix. You can't just say, just get outsiders, boards are going to, and I think that's what Sarbanes and Oxley missed. They thought the end game was having independent boards will also create effective boards. But as many of you are going to find, when you look at your companies, you have boards that are technically independent and completely ineffective. So you're saying, what's the alternative here? Look to the Catholic Church. There's a reason the Catholic Church has survived and prospered for 2,000 years. They've dealt with every problem a company's dealt with. They've dealt with before. They've had their own ways of dealing with it. Maybe we can learn from it. And let me flesh this out. In the 1400s, the Catholic Church had a problem. You know what the problem was? Too many people were becoming saints. If you ever tracked how people become saints, it's actually a pretty elaborate process. Somebody from some part of the world says, hey, we have a saint in our midst, usually a person who died. And then they show up in Rome with the name of the saint and evidence of miracles the saint has done. And then the church decides that the miracles get to the threshold of you're now a saint. And what the church was discovering was that the people who were promoting the saints had the resources and the motive to do all the hard work of collecting information. And there was nobody in Rome with the equivalent motive to push back. Because you don't have the time to go push back. And people are just getting, I mean, you had hundreds of, I don't know how many made it to sainthood, but everybody was making it to sainthood. So you know what the Catholic Church created? The devil's advocate. That's an amazing name. I wish I'd come up with that first. But you know what the devil's advocate's job was? To be the counter. So think of him as the person who counters the saint. So you come up and say, there's a miracle. The devil's advocates are not a miracle. And they were the devil's advocate was given the resources, and this was his only job. Resources and the team to kind of challenge people. See, what's this got to do with boards of directors? What's the problem with the board? The CEO gets up and says, we have to do this acquisition. It's in the best interest of the company. Who in that room has the incentive or the resources? Even the CEO will get a bank and 3 banks to come in and show you all these projections of synergy. And you're sitting there, I don't believe these numbers, but I don't have the resources, challenge. So what if we created a counter CEO in the board, like a devil's advocate CEO? And you know what that counter CEO's job will be? Everything the CEO says, the counter CEO disagrees with. The CEO gets up and says, we have to do the acquisition, hires JP Morgan to back it up. The counter CEO says, we shouldn't be doing the acquisition, hires Goldman Sachs to counter the numbers. It'll be chaos. I don't think it can ever happen. But until we get a counterweight in that room, boards are not going to be effective. So I'm going to end today's session by looking at Disney. I told you it's going to be my lab experiment. And this is Disney in 1997. At that time, Disney was run by a guy. The CEO of Disney was a man called Michael Eisner. A man whose ego was so large that he could be in a big room by himself and still felt crowded. He was, for lack of a better word, the CEO who essentially ruled the company. He did not like dissent. And he created a board of directors that did not challenge him. And I'll go through the Disney board. which I'm going to argue is one of the worst boards ever created in the history of corporations. And that's the pretty big test to win. Okay? And talk about what made the board so bad. First, it had 17 members on it. You think, so what? I want you to try something. At the end of this class, I want you to get together as a group of 17 and try to decide where to go for lunch. I'll make a prediction. You will not eat today. When you have 17 people sitting around a table, nothing gets done. If you want to create an ineffective board, have 25 people on the board. Right? So that's strike one. Second, 8 of the 17 members were insiders. People who either worked at Disney or used to work at Disney. So you can already see it's tilted in favor of management because you got management on the board. So strike 2. Who's the chair of the board? Oh, Michael Eisner. So let me get this straight. You're chairing the board that's going to oversee how you're doing, and you're going to tell me whether you're doing a good job. It doesn't even make sense as I say it. Strike 3. If this were baseball, he just struck out. This is such a bad board, I'll give them a 4th strike. Let's take a look at some of the outsiders on this board. There's Revetta F. Bowers, head of an elementary school. Do you think this is good? Disney is a kid-oriented company. She's around kids all the time. This might be pure coincidence, but Revetta Bowers was the head of the elementary school that Michael Eisner's kids went through. I'm sure it's pure coincidence. Pulled it out of a phone book. Let's keep going. George Mitchell, ex-senator from Maine. What's he doing? I have no idea. Father Leo O'Donovan. Anybody go through Georgetown here? Georgetown grads? This again might be pure coincidence, but Michael Eisner's son went through Georgetown. He sat on the Georgetown board and he'd made a substantial donation to Georgetown. I'm not suggesting there's any quid quo pro, but it doesn't pass the smell test, right? And let's do one final example. Irwin E. Russell, attorney at law. See, what do you have against lawyers? A whole ream of things, but this is not the forum to talk about that. But he happened to be Michael Eisner's personal attorney. How the heck do you get away putting your own lawyer on the board? Say, trust me, he's going to be an objective third party. It's nice to have your lawyer in the room all the time. So I said, don't answer that question, Mike. Take the 5th on that one, Mike. But you can't tell me he's going to give you solid objective advice. This is a classic rubber stamp board. And if you look at some of the really stupid things that Disney did in the 1990s, we looked at it from the outside and said, why would the board not stop Michael Eisner from doing it? The answer lies in who sits on the board. Next class, when we start off, we're going to look at some of the things Disney did in the 1990s. And then we're going to say, well, why did the board get away? Let Eisner get away with it? The reason looks in who sits on the board. So what I'd like you to do, if you pick a company soon, hopefully before the weekend, is take a look at who sits on the board of directors. And I'll send you some places where you can get at least some data on what their conflicts of interest might be. Let's get the process rolling. I will see you on Monday.